When it comes to achieving a lifestyle sustained by passive income, I believe there's no superior option than relying on dividends. While other possibilities like owning real estate, selling books, or starting a blog exist, there's really nothing out there that requires so little work to maintain than being able to live off dividend distributions from your investment portfolio. Now, there are a lot of stocks that pay dividends, but they're not all alike. How can we pick the good ones? Whether you're a newcomer to investing or have been in the game for decades, you've probably heard of Warren Buffett, widely hailed as one of the greatest investors ever. Interestingly, his preferred stocks to invest in are those that pay dividends. If the world's fifth wealthiest person prefers investing in dividend stocks, it could be meaningful. Dividend investing is popular for its ability to generate passive income, and Buffett, through his company Berkshire Hathaway, invests in dividend-paying stocks. He openly advocates for dividends, and it's a strategy worth considering. To begin, it's essential to grasp two types of income: active income earned through work and passive income earned through investments. The key is to use your earnings from work to build passive income. This involves setting aside a portion of your salary for dividend-paying stocks. Unlike real estate, which demands significant capital, dividends allow you to start with as little as $100. Warren Buffett says, "Big opportunities in life have to be seized. We don't do very many things, but when we get the chance to do something that's right and big, we've got to do it. And even to do it in a small scale is just as big of a mistake, almost, as not doing it at all. I mean, you really got to grab them when they come, because you're not going to get 500 great opportunities. Take it as a big opportunity." You know, public companies like Coca-Cola attract investors seeking regular dividends, creating a steady cash flow. Buffett always emphasizes the effectiveness of companies like See's Candy that distribute earnings to shareholders when they can't wisely reinvest large amounts in their business. Coca-Cola is a company deeply endorsed by Buffett and also has a solid reputation, and its extra cash can be saved, reinvested, or paid out as dividends. Coca-Cola presently provides a 4% annual dividend, distributed quarterly. Owning one share would yield $1.84 annually. Though seemingly modest, having 10 shares would boost your yearly earnings to $18.40, and with a $1,000 investment, you could anticipate $18.40 annually. To achieve $3,300 monthly, a total investment of $1.295 million would be necessary. The advantage of stock ownership lies in potential appreciation, leading to increased dividends. Coca-Cola's dividend payout has grown over the years, from 28 cents per share in 2013 to 48 cents, nearly doubling. The stock price has also risen by 60% since 2013, highlighting growth potential. Warren Buffett's investment advice underscores the importance of stocks with above-average appreciation potential and secure growing dividends at appealing prices. While Coca-Cola is a viable option, other stocks in Buffett's portfolio, such as Synchrony Group Bank with a 4.5% dividend rate or Vitesse Energy with an 8.68% dividend yield, offer alternative investment opportunities. However, pursuing the highest-paying dividend stocks may not be the best strategy, as sustainability is very important. Some companies with extremely high yields may be financially unstable, potentially facing bankruptcy. It's essential to evaluate whether a company can generate more value than the dividends it pays out. Imagine having large investments in a company boasting an enticing 10% dividend yield, offering significant payouts. Unfortunately, poor financial management leads the company to bankruptcy, resulting in a complete loss of your investment. So, while high dividends may be attractive, they also mask underlying issues that companies prefer to keep hidden. Warren Buffett's wisdom teaches us that time favors excellent companies, but works against mediocre ones. For those hesitant about individual stock investments, exchange-traded funds, ETFs, provide an alternative. Two noteworthy options are VYMI, focusing on high dividend-paying companies with a current yield of 4.53%, and FDV, offering a 3.8% yield. While ETFs require less research, it's still advisable to check the listed companies with a quick Google search. Real estate investment trusts, REITs, offer another avenue, especially appealing to those interested in real estate. Similar to stocks, REITs can be bought and sold on the stock market, but exclusively invest in real estate. They are legally obligated to distribute 90% of their profits to shareholders, resulting in high dividend payouts. XLRE boasts a 7.44% dividend yield, requiring a $520,000 investment for a $40,000 annual return. Another option is iShares Cohen & Steers REIT ETF, yielding 5.86%, necessitating a $665,000 investment for a $33,300 monthly income. To achieve solid growth, let's revisit the Coca-Cola example. With a current dividend yield of 3.04%, reaching a $40,000 annual income would require an investment of approximately $1.295 million. The path to accumulating $500,000 or more involves strategic investment decisions and a commitment to the principles of long-term growth. Dividend investing, following the Warren Buffett approach, is not a one-time large investment, but rather a long-term strategy. The key is consistent investment in dividend-paying stocks. For example, starting with 10 shares of Coca-Cola and adding 10 more every month over 10 years could lead to an annual dividend income of $3,900. Doubling the monthly shares to 20 could result in $5,975 in dividends. The power of compounding interest further accelerates wealth growth. Through reinvesting dividends using a dividend reinvestment plan, DRIP, you can compound your returns by putting the earned money back into the stock. Adopting this strategy, purchasing 20 shares of Coca-Cola monthly for a decade and reinvesting dividends could potentially generate an extra $1,000 per month. The continually growing value of your assets contributes to an abundant nest egg, possibly nearing $500,000. It's essential to say that dividends are taxable income. When pursuing a strategy to live off dividends, consider these steps. 1. Decide what to invest in, whether it's stocks, ETFs, or REITs. 2. Automatically invest any earnings into your chosen investments. 3. Always reinvest your dividend money to leverage the power of compounding. 4. Be mindful of tax obligations on the dividends you earn. Despite a gradual outset, by maintaining patience and consistency, you have the potential to accrue a significant income through dividends and actualize the life you've aspired to lead.